Hello, I'm Mary Reed, National Director of Qualified Plan Marketing for Alliance Benefit Group Pentegra. We are a third-party administrator of qualified plans and currently administer about 3,500 plans. Our parent company, Pentegra Services, Inc., has been in the pension business for nearly 70 years. Together, our expertise and talented staff helps find solutions for clients. Welcome to our training series for financial professionals. In this series, we will use our expertise to help prepare you to find prospects and write qualified plans from closing to establishing the plan and further administration. Let's begin. Hello and welcome to our discussion on life insurance in defined contribution plans. First, let's talk about defined contribution plans in themselves. Who's a typical candidate for a defined contribution plan? In our world, closely held businesses, typically with fewer than 10 employees, who are looking for current tax deductions. Hopefully we can get that plan designed efficiently so that the tax savings exceed whatever has to be put in for the employees. And perhaps they're interested in buying life insurance and paying for it with pre-tax premiums. They may also be looking to save for retirement, and they may want to save a couple of $1 million for their retirement, which they can do in some plans. And they may be very interested in the protection from creditors. All of those could lead someone to think about putting in a qualified plan. Of course, the tax advantages often are a driving factor here. There is no time like the present to benefit from tax deductions, very appealing to business owners and their CPAs. The plan could end up looking very nice. I have an example case here on slide 4, typical candidate for a small, closely held company for a qualified plan where we can get the lion's share to the owners. Here we have 2 owners, each of them getting $50,000. We're only putting in $4,500 for the 2 employees. The owners are getting 96% of the total. Very appealing for them. They're getting the lion's share, just like most of them would like to do. Looking at the after-tax cost of this plan on slide 5, we can see the tax savings because of the deduction here is $41,800, with only $4,500 being given to the employees. The owners are coming out ahead, $37,300. The way we come up with that number, the total contribution minus the tax savings gives their net after-tax actual cost for the plan of $62,700, $100,000 being deposited for our owners. They're coming out ahead, $37,300. It's a very nice deal for them. And so, their choices, if they didn't do the plan, they could give a lot to Uncle Sam. They could give all those taxes, the $41,800. Or by doing the plan, yes, give up a little for the employees, give them the $4,500, but look how much further you come out ahead. So the plan may make sense, but let's talk about the business owner themselves. If you see my slide 7, should we add life insurance to the plan? Is there a life insurance need? Well, unfortunately, statistics tell us that 3 out of 20 will die before they reach age 65. That includes business owners. They are not exempt. 3 out of 20 of them will die before they reach age 65. In that event, there's probably a very valid reason to have the life insurance. And if they think that they're immune, just remember that of those that make it to age 65, 100% of them will die thereafter. So why would we put insurance in the plan? Besides their need, let's talk about you. These are statistics from insurance written by a National Life Insurance Company. These are from 2010, although the 2011 numbers are very similar. Typical premium on life insurance and a defined contribution. Average plan contribution $48,000 with premium being $15,000. You can see the numbers are much higher in the defined benefit scenarios, but even in a profit sharing plan, the numbers are quite substantial. Now the contributions are lower because there are limitations in these plans, and an average plan contribution of $48,000 means that's probably a 1-person plan, maybe 2. So you start doing these in slightly larger plans, 3 employees, 4. Those numbers will go up very quickly. But let's go back to the employer's point of view. What does the insurance do for them? Well, first of all, it makes the plan self-completing. If they're planning to save this money, maybe they have some thoughts of actually using this money for their retirement. They're not only driven by the tax deduction, but they want the money later on. We know if they should die along the way, unfortunately, not as much money will be there, and maybe they're leaving behind someone who's counting on having that money for their retirement, like a spouse. Putting life insurance in the plan can guarantee that it will be self-completing. It's also a place to find money. They may have another insurance need that has nothing to do with the plan. They may need it for buy-sell. They may need it for estate planning. They can need it for any number of reasons, and paying the premiums in the plan is just a cheaper place to buy the insurance because you're doing it with tax-deductible dollars, which is always cheaper. Another reason that's not on the slide here is it's a way to bring back an employee benefit that maybe they would like to give their employees but can't afford. If they're making a profit-sharing contribution for employees, the amount that goes to premium would come out of that contribution and won't cost the employer anything additional, but could provide substantial benefits for those employees that maybe they otherwise can't afford. So let's go to slide 11. What are the advantages? It's tax-deductible premiums. So because you can have tax-deductible premiums, that means you could buy the same amount of coverage you would buy outside, but it will cost you less. Or if you can work with the same number of dollars, you can spend the same amount and get more insurance. And if you have someone who's rated, so their premium is going to be higher because they have some health issue, this can be even more effective to keep their costs down. Now, when we go on to, we're not going to talk about defined benefit plans right now, but those same things leverage whether you're doing defined contribution or defined benefit. Defined benefits, you even get some more leveraging on that money, but it certainly works very well in a profit sharing. Now keep in mind, when we're doing profit sharing, the premiums will come out of any plan contribution, so it will not add to the cost of the plan. In fact, the life insurance could be viewed as an alternative to a conservative investment. Some people think about it that way. Insurance is not an investment, it is insurance, but you're buying permanent insurance here. It's not term insurance, always permanent insurance. So we'll be building cash value, and that could be instead of putting it into a conservative investment. And as we already said, that the value can help self-complete the plan in case the person should die prematurely. So on slide 13, I have an example here. I have someone who's 58. We're buying them a little over $500,000 worth of life insurance. The premium for that policy would be just over $17,000. So if they were going to pay that $17,000 premium outside the plan, they would need $26,000 and change of income to pay the taxes to net the amount to pay the premium. Here, it's just straight plan contribution, plus they get a deduction for it. So once you take into account the deduction, it's really only costing them out of pocket a little less than $9,000. So almost half the cost to get that same coverage. There are limits as to how much insurance we can have. You can never spend more than 25% of the total contributions in the plan for if you're buying universal insurance. If you're buying whole life insurance, that number is less than 50%. So you add up the total plan contributions and you apply it to that number, and you must always stay under that. You must always stay within the limits. Now, in profit sharing plans, there are some more lenient rules. You do escape those limits, and you can use 100% of the money that's in the plan if you follow these rules. The first rule has to do with what's called aged money. You look back 2 years, and any money that's been in that plan for more than 2 years may be used entirely for life insurance premium. The less than 2-year-old money is subject to the limits we already talked about, but the old money is available. Once someone has been a participant for more than 5 years, then all limits are off their account and all the money is available. And lastly, if you roll money into a profit-sharing plan, let's say someone had IRA money and they roll it into the profit-sharing plan, that money is also 100% available. No limits apply to that money. So what are some of the objections that a business owner might have to putting life insurance in the plan? First objection, life insurance creates a commitment. So one of the great things about profit-sharing plan is that you can flex the contribution each year. You could put in 25% of payroll this year, put in nothing next year. You could change it every year. When you have premium to be paid and you have to stay within those incidental limits, that locks you up a little bit and takes away some of that flexibility. Well, you can be saved if the plan has been around for a while. If the plan has already been around for a while, so you have seasoned money, either more than 2 years old or more years of 5 years of participation, or you have IRA rollover money in there, then you have that money to draw from and you escape the limits. One argument is that, it diverts money away from other investments. Well, that may be true, but again, it could be comparable to a conservative investment you might choose to put your money in. In fact, some people view it that it allows them to free up and be a little more aggressive with their other investments because they've got guarantees here. A misnomer also is that the death benefit from the insurance will be income taxable because the premiums were paid with pre-tax dollars. But that's not true. Any cash value that accumulates in the policy is taxable, but any net amount at risk, the pure life insurance protection of the policy, the difference between the face amount and the cash value, passes income tax free when the benefit is paid. Now, there is a small price to be paid by the employee while the insurance is in there. Because adding life insurance to a profit-sharing plan is a current benefit, not a future retirement benefit, there's a current benefit today, and that is reported out and added to the income of the participant based on its value. What's reported out is what's called the economic benefit. It's an alternate term rate. It can be an alternate term rate, or it's a government table rate that's reported out and added to that employee's income, but it is pennies on the dollar. And they do get that cost back as basis later on, should they take the policy as distribution, or should the death benefit be paid and the cash value is taxable, it's recouped as basis against that. Now, how much are we talking about? I have a chart on slide 18. Look at the first person there, age 45. This used to be known as the PS58 cost. It used to use that table. For $1 million worth of coverage, that table would have reported $6,300 of income that would have been added to that person's W-2. Those tables were changed. It was switched to table 2001-10 quite a while ago, so that reduced the cost a lot, dropped it to $1,530. Companies are allowed to use their own alternate term rate if they meet the requirements of the rules. Some companies do, some don't. Here's an example one from one of the companies. It would be $500. So some companies have it, some don't. You have to look at whatever company you want to use and see whether they use their alternate term rates and what they might be. They could be quite a bit lower than the table 2001, but it will vary from company to company. In this example, you can see the whole life premium for this policy was actually $17,000. The reportable amount off of table 2001 would only be $1,530. And even when you look at our 60-year-old, the premium is $37,800. The table 2001 reportable is only $65. And if you found a company with their own alternate term and it was low, it might be as low as $1,500, maybe $2,000. Just check with your company. Now, it's great having the insurance in there and paying for it with tax-deductible dollars, but eventually it has to come out. So you have to think about exit strategies and how are we going to get that policy out. First way, they can always surrender the contract. If they don't want the death benefit anymore, they don't want the insurance, they can surrender the contract. Any cash in that contract will be added to their account, can be rolled to an IRA to defer taxation. You could distribute the contract. Let's say they want to keep the contract when they leave, separate from service or retire. They can take that policy with them. You can even distribute it in service if your plan allows for that while they're still working. That way they keep the death benefit, they keep the policy, but they will have to pay tax on the cash value, essentially. They have to pay tax on market value, which is a calculation that's beyond most policies is going to be close to cash value. They will get those taxable term costs they paid back as basis, so depending on how long the policy's been in effect, that may or may not be a big taxable event. If they don't want to pay the tax, they could buy it out. They can buy it out for its fair market value. That's a calculation that's done under the rules, not necessarily the same as cash value. They get the policy intact, so the policy still has its cash value, still has its death benefit. The challenge here is they have to have the cash ready to be able to do that. The cash they pay into the plan, they're giving to themselves, that they can then roll to an IRA in the future, so they get it back. They're not losing the money, they're just buying it from themselves, but they need the cash flow to make that happen. The fourth alternative is offered by some companies, not all. There are a few companies that offer this, that you could exchange the policy. Typically, it's surrendered in the plan. The cash value will stay in the plan and roll to an IRA. The company issues that individual a new policy outside the plan. It's now their privately owned policy, and there was no taxable event. They didn't have to pay to buy it out, but they have a new policy outside the plan. Again, depending on what company you want to work with, look into and see whether they have those features available. So that's just kind of the quickie lesson. Life insurance can be a great advantage in a qualified plan. Also, whether it's for the business owner themselves, whether it's to give back an employee benefit to employees, whether it's to self-protect that benefit, any number of business and personal reasons can be needed for that life insurance. You may find the profit-sharing place is just a less expensive way for them to buy it. Call us if we can be of help. We're here to help you. Thank you. If you'd like additional information, please visit our website at abgpentegra.com. You can also reach me via email at mread, that's R-E-A-D, like you read a book, at abgpentegra.com, or you can call me at 802-477-2018. Thank you.